As we move on to the next section, we can talk about sensitivity of our analysis and do some what-if analysis. So essentially, this is going back and answering these questions. The business dropped off and you only did 1,200 deliveries per year. Would your recommendations change? We'd already looked at that before. And we said, well, if this had been 1,200, then we broke even. If this one had been 1,200, we would have a net present value that would be significantly negative. And under the first one here, if we drop to 1,200, we find that we would lose even more money. Essentially, we'd have a fixed asset that we had to pay for, but didn't have enough utilization of the fixed asset. Part B of this says, what happens if we had 1,600? We can go back to our original picture here, change the numbers to 1,600, and see what happens. Here we make $72,000 net present value. And remember, that's on top of the 12% that we said we needed to get. Internal rate of return of 33%. So that's going up pretty fast. If this one were to change to 1,600, it goes up even faster. This is because we don't own the truck. This asset belongs to somebody else. And even though it only covers a 4-year period, it gives us a lot of flexibility. And in the final case down here, if I change this to 1,600, we're making plenty of higher internal rate of return percentage, but the dollars don't go up very fast. So alternative B is the one that I like. And I'm just going to copy everything from alternative B here and move it to the sensitivity analysis page. For part 3, we're going to look at the break-even point for the project. So we go back to earlier chapters for our thinking on this. We see we have sales, we have labor, we have gas. To do break-even, we need to put that in terms of unit costs and fixed cost and variable cost. So I will copy my years across, something like that. And we need to know our fixed cost. The fixed cost in this case is going to equal our $30,000. And we can copy that one across. So in each year we have a fixed cost of $30,000. And we have variable cost we need to look at. And they equal all of our labor, gas, and maintenance. So in this case, it's the sum of labor, gas, and maintenance. Now, really, we want the variable or cost per unit. I'm going to actually pull it down here because we need also the price per unit. So we know how many units we have. We can divide that by 1,400. I want to stay in that C9 cell, so I'm going to press the F4 key to lock it in. I have a cost of $69.29. Then I want to pull that across. For my fixed cost, it's $30,000. My price per unit is equal to my total revenue divided by the number of units. And again, I want to lock that in so that when I copy my formula, it copies it across appropriately. And let's put those in dollars. And we'll pull that across. So now we're looking for our margin per unit. How much we make it on each unit that or each delivery we make. And so that's just simply the difference between the two. Something like this. We do our break-even calculation. It's equal to the $30,000 divided by the margin we make per unit. Now, we don't do partial units, so we need to make sure we're rounding that off. And if we pull that across, it'll automatically adjust by formula, so it's calculating in each case. We're seeing the number of units go up over time. It's partly because we're making less money on each unit. So then they ask the question, would it make sense if we made labor a fixed cost? Before we had treated them like an hourly person that you could send home. If you didn't have enough business, you just send them home, kind of like McDonald's does. That's really asking us to do this calculation one more time. So I'll just copy it over. And in this particular case, our fixed costs are going to equal the 30,000 we had before plus our labor cost. So we have higher fixed costs, and our price per unit is going to remain the same. So I'll just say equals and point to the one above it. So nothing changed about the price per unit. The cost per unit is going to equal the sum of gas and maintenance divided by number of units, and again we want to lock in the number of units, so it's F4 does that. And I can copy that across. I can check this formula here, so it's now moved to the F column and it remained in cell C9. This moves to the G column and it's in C9, so I know that the cell formula is correct. Because of how I've done this, that now gives me the break-even numbers. So this is the answer to the question down here. And you can see that if we make labor a fixed cost, the number of units needed to break even is higher. Now that's assuming how many hours I'm going to actually hire this person to work. With a person that is on your payroll, you can't send them away and only work them 6 hours because you don't have enough deliveries. Whereas if you put them on your payroll and have a fixed cost, you can use them for other things, so it's not necessarily a bad thing in this case. You can also use that person to be your customer service person and make sure that customers are really happy. So if you have to give something away, you don't have additional labor costs. Our last problem is a replacement problem. So we see Lancaster Corporation purchased a piece of equipment 3 years ago for $250,000. It has a depreciation ADR midpoint of 8 years. So if we look that up on page 400, we find an ADR of 8 years uses the 5-year MACRS table, and the old equipment can be sold for a price. So we also find the new piece of equipment is going to be purchased for $360,000 and has the same ADR. We look and assume that the old equipment would provide the following operating gains. We're not asking us to do all the calculations again to come up with the cash flow, but essentially we're going to need to copy these numbers down because we need to know what has changed. The first step of this is to copy down some of that information and understand what's going on with depreciation. First of all, our old equipment we purchased 3 years ago for $250,000. And in the first year of its life, its depreciation would have been 0.2 times the amount that we paid for it. and I want to lock that cell in, so I'm going to lock in column B. I don't necessarily want to lock in the row this time. You can see that our first year we're allowed $50,000 in depreciation. If I copy that across, I get the depreciation for each of the years. In fact, if I add all of them up, it needs to total $250,000, and it does. Second year, we're going to pick up our MACRS table and multiply that by the 360,000, and we'll press the F4 so we keep that locked in, and we can see what the depreciation looks like for that new equipment. Now we're told that 3 years have already gone by, so in the case of the old equipment, we've already taken a certain amount of depreciation. That's past. Old equipment, it's starting year number 4, and the new equipment will be starting its year number 1 if we bring it in. So this is important because we've already subtracted off this depreciation here, and we're going to lose the depreciation for the old equipment when we get rid of the old equipment calculation. We're going to gain the depreciation for the new equipment. We're ready then to look at the change in revenue. In each of these years, operating earnings before depreciation and taxes is going to equal the $100,000 we get for the new equipment. We might be buying something that is very efficient and helps me increase sales, and the $36,000 if we didn't change and stayed with the old equipment. That's really the change in revenue here for that first year. Our second year is going to equal the $86,000 minus the $26,000 we would have gotten off the old equipment. Year 3 is the $80,000 minus the $19,000. Year 4, the $72,000 less the $18,000. Year 5, $62,000 minus the $16,000. And year 6, the $43,000, and it's minus the minus $9,000. So in the old case, it would have cost us money in that last year. So it's a cost avoidance in that last year. We'll actually call it the change in operating revenue. And we need to know about the change in depreciation. So in this particular case, we're going to have $72,000 in depreciation, and the one that's going away is year 4. 1, 2, and 3 have already passed. So that gives us a change in depreciation. And I can copy that over for 3 years. After the 3 years is up, there is no more depreciation for the old equipment. So if I carry that forward, it just reflects the new equipment depreciation in years 4, 5, and 6. Now I have my earnings before tax, EBT, and that's equal to the 64 minus the 43, and we can take that across, and we can say taxes are at 36% times my earnings before taxes. That gives us our earnings after tax, which is going to equal 20,000 minus by 70. And remember, we add back in depreciation, add back in the change in depreciation. That equals cash flow. We know what to do with cash flow. Net present value, IRR, payback. So all that remains for us to do now is calculate what happens at year zero. What is the cash flow? We know we have the purchase of the new equipment. We know that we have the sale of the old equipment. And we have the net tax on the sale. So there is a tax available on the sale. All these things combined give us our cash flow in year zero. We have 360. I'll just bring the numbers across. The purchase of new equipment cost us 360. The sale of the old was 97,920. The net tax we don't know yet, so we really can't calculate it until we understand how much it really cost us. So purchase of old equipment came in here, and that cost us $250,000. We have accumulated depreciation for the old equipment. And that's equal to the sum of those 3 years of depreciation that have already occurred. This gives us the book value of the old equipment. Now we know that we sold old equipment, and that was the 97,920. We had a gain on the sale of equipment, and in this particular case we need to pay taxes on it. The gain on the sale was 97,000 minus the 72, and the tax on the gain would be equal to 36% times by 25,920. That's the amount we need to bring up here as taxes. Our net cash flow is equal to sale of the old minus the net taxes minus the purchase of the new piece of equipment. That gives us our year zero cash flow. So we're ready to do NPV. It's equal to NPV, left parentheses, I see 9% is the cost of capital, comma, and the values we want to include go from year 1 to year 6. And we put in the right parentheses plus the amount of year 0, and that gives me a net present value for the project. Internal rate of return then is equal to IRR of year 0 through year 6. No surprise, it runs 5%. And payback, we paid out 271, and we're up to 234 there. We're up to 278, so it's just shy of 5 years. Payback is 4.9 years. So now we're ready to talk just basically about this project in general. we might say that this does not meet the hurdle rate of 9%. We shouldn't do the project. And that probably is a valid argument. The other argument that might be made is that by putting in the new equipment, we have the opportunity to perhaps take in additional business is not considered here. New equipment might keep us state of the art. It might keep us able to keep our customers happier. So there are some esoteric things that have to be considered when you make these kind of decisions. We don't just give up because the internal rate of return is not high enough. What we would do is we would look at other alternatives for how we might be able to make this purchase work. The 3 steps: we need to determine what happened to the depreciation, and it's really the difference in depreciation that we are interested in. We need to understand the difference in operating revenue that came about, and when we combine those, we have the change in earnings, calculate the change in taxes, and we determine a cash flow for the whole project. And the 3rd step, of course, is the determination of what happened in year 0. We have to take our old equipment and find out if we owe taxes or we're going to get taxes back. So this could be a negative number if we sold the item that has a book value of $72,000. If we sold for $52,000, then it would have cost us $20,000. That would give us a tax rebate, assuming we had other revenue to offset it. And so we could actually be getting taxes back. We put that into a cash flow and to determine net present value, IRR, and payback. And finally, we look at the details of the project and try and make a determination of whether the project makes sense, not strictly by the numbers, but by what it means to us. In this particular case, if it's strategic to the company, we might argue for this project anyway, no matter what. Just because it doesn't make a sufficient return on revenue doesn't mean we give up. It just means that we need to have a more in-depth discussion about approaches. For example, we might actually look at leasing that new equipment instead of purchasing the new equipment. And that concludes this session.